Well, stocks are near record highs, but there are some factors coming back into play that could threaten the rally. Lindsay Piegza is here. She's the chief economist at Stifel Fixed Income and is here now to talk more about this. So, Lindsay, what do you make of actually the declines in oil we've been seeing? Because that's a big factor that could threaten this rally. We've got oil flirting with $40 a barrel, but some are worried it's going to head back into the 30s.
Yeah, and that 35 mark, that really is a psychological threshold, reigniting fears of the fragility of the global marketplace. As oil prices were creeping back up, a lot of investors felt as if the global market was beginning to firm and there were better economic conditions around the corner. Now with oil prices retreating, a lot are questioning whether or not this may be really as good as it gets from here.
And we had weekly crude inventories rise 1.4 million barrels, missing estimates of 1.7 million. So certainly, I mean, if we see oil move back into the 30s, is that bad for stocks?
Well, I think it will cause uncertainty and certainly a tremendous lot of volatility in the equity markets as we try to sort out whether or not this was a short-term step in the wrong direction or if this is a longer-term trend and prices will continue to retreat from here.
All right, let's shift and talk about growth. Of course, last week we had a pretty weak GDP print for second quarter, up 1.2%. The consumer was strong, but everything else not so much. What's your take on what we saw there?
A lot going on in that second quarter. First of all, that top line number, as you mentioned, a big disappointment. Most were looking for above 2%, so really giving us this sense of a rebound in the second quarter.
Which is something we normally see.
Well, we have seen it before. Certainly in 2014, we had nice back-to-back quarters of above 4.5% growth. We weren't necessarily looking for that, but we were looking for a rebound. We missed that, and now we're talking about an average growth rate of just 1% across the first 6 months of the year. Now, you can argue in the details, the consumer was relatively strong, doing the heavy lifting for sure. But when we look at the other components falling into negative territory, specifically business investment, well, now looking forward into the second half of the year, you can't expect the consumer to maintain this type of spending if we don't see business investment markedly improve.
So we could see GDP growth fall below 1%.
Absolutely, absolutely. And for the year of 2016, we're looking for just 1.5%. So well below that trend rate of 2.1 established at the end of the Great Recession.
Well, and that's incredible. I mean, what does this mean? This is likely yet another pickle for the Federal Reserve, which, there's been some increased chatter about a September rate hike amid some better than expected jobs numbers, and we'll get another reading on Friday. But what does all this mean for the Fed? Are we looking at a September hike?
It's going to be very difficult for the Fed to justify a rate increase anytime soon. Now, we have heard from some Fed officials that all meetings are live and they're certainly going to remain data dependent, but all the data suggests that, again, the Fed is going to be on the sideline for an extended period of time.
All right, all issues we'll be watching. Lindsay Piegza from Stifel Fixed Income, thank you for coming by.
Thank you.
I'm Scott Gamm, and you're watching The Street.